So first of all, I just want to clarify, expenses reduce your profits, okay, and then you're taxed on your profits, or you're taxed on less. So sometimes people have this misconception that you can claim an expense back in full, perhaps from HMRC. It's not quite the case. You're taxed on essentially your bottom line profit. So you've got your sales and your turnover, less of all your expenses, and then you're taxed a percentage on what's left over. So when someone says something is fully deductible for tax purposes, what that means is it comes off of your profits in full, and then you're taxed on a lower amount, basically. So the key rule is wholly and exclusively, okay? So that's like the first thing you kind of have to think in your head. Is it wholly and exclusively for business purposes? So what I mean by that is all your normal stuff, so stock, premises costs, office costs, professional fees, bank charges. Of course, that's all fine. I mean, there's an endless list of what you can claim. It depends on what your trade is. But yeah, generally speaking, as long as it's for business use, then that's absolutely fine. You can claim that if you're trading through a company, or as a sole trader or a partnership. The rules are pretty much the same for normal expenses like that. So some things are a little bit more unusual then. So, well, not unusual, but funny areas. Mobile costs, telephone and internet. So say, for example, you've got a mobile that you use half in the business, half personally. The rules are slightly different for a company compared to sole trader. So as a sole trader, you can basically claim a portion of all those costs. So if you used your mobile half the time for business, half the time for private use, you could claim 50% of your costs. It's just coming up with something that's reasonable there. For a company, you can claim for all of the costs, but the contract has to be in the company's name. And again, it's just linked with it being a separate legal entity. If it's not in the company's name, you can't claim for any of the costs. Well, you could, but there'll be a tax charge on you, so there's not really any point in doing that. The same thing goes with telephone and internet. Again, obviously, if these are telephone and internet lines at an office, then yes, that's fine. There's no problem with claiming in either or. If you've got a limited company and you're running it from home, and you've got, say, like a, I don't know, Virgin Media package or a Sky package, and all inclusive in that cost is your TV, which is private. But you also use the telephone and the internet line for business purposes. Then that's not then allowable. Whereas with the sole trader, if you can come up with a reasonable split, you can still claim for a portion of the costs. So the sole trader structure is actually a little bit more flexible than limited company one is. Motor expenses, again, you can talk for a while on motor expenses. The key thing you can change is either claiming a mileage or actual costs. Now this should be pretty straightforward. I will do a separate video on this. Essentially, if you're claiming a mileage, which again I'll talk about the rates, normally 45p up to 10,000 miles per tax year that you can claim. Again, that's fine for all business journeys, and you can claim that as an employee through your company or as a cost for your sole trader business. Actual costs, so what I mean by that is claiming for the cost of a vehicle, so like a works van or something. So you claim for the cost of the van, cost of running the vehicle, so insurances, road tax, fuel, etc. Again, for a sole trader partnership, you would add back or disallow any private portion of that. So you only claim the business element. For a limited company, the rules are slightly more complicated. Essentially, yes. When you're claiming for a car, that can potentially be very expensive through a limited company. So yeah, definitely seek advice in that area, but I will do a separate video on the company car tax rules, and essentially the tax charge on the directors and the shareholders if you're running a car or a van through a company, and you're using it privately as well. As for expenses that are incurred prior to starting the business, so pre-trading expenses, yeah, so long as they're incurred within 7 years, and they were incurred, again, wholly and exclusively for the business, you can claim that in both the limited and the sole trade business. So there's no problem there. Okay, so as for exceptions then, Again, this is a whole other topic, but I will just cover it very briefly. Assets and depreciation of assets. So I'm talking about if you're buying vehicles, if you're buying machinery for your business. You can claim for those, but the claim is separate. It's something called capital allowances. So essentially this isn't an expense of the business because they're lasting. If you buy a machinery that's going to last you 5 years, it's not an expense, it's not an overhead or a direct cost. It's actually treated as an asset in the business, and then you depreciate that and claim for it over a period of time. Now the tax treatment is actually normally pretty similar to the same as your normal costs, but the way in which you claim that is different basically. So clothing, an unusual one. Again, clothing is generally acceptable if it's safety clothing, or if it's got your logo on it, so it's uniform, for example. That's fine because it can be treated as advertising almost. If it's just general clothing, it's not allowable. And there's quite a lot of case law about this. And their argument is, or the cases that have been declined in court, are that clothing provides warmth and normal decency. It's often apostrophe. So yeah, it falls foul of it doesn't satisfy the wholly and exclusively, because you need clothing to walk around like a normal person. So yeah, that's maybe a bit of a harsh one. I mean, it's like, accountants or someone in court with their gowns on or whatever they wear. It's even though that might be just for work, they still need to wear something to keep warm. So it's unfortunately not allowed. But like I said, if you could put logos and things on it and turn it into effectively a uniform, in which case that would be then fine. So repairs and maintenance, again, I've just put careful here. So generally speaking, that's fine. So what I mean by that is if you've got office expenses, or you've got a work unit or something, and you're just doing kind of small repairs and maintenance, generally speaking, that's okay. You've got to be careful with large repairs and maintenance. So if you're changing like structures for things, then yeah, that's not perhaps treated as capital cost instead of a revenue expense, which would be effectively offset against your tax. Here there was a case with Odeon Cinemas as an example. So they purchased some cinemas that were in a rundown state, and then over time they then repaired them and did maintenance to bring them back up to like a better standard, if you like. And the revenue were trying to argue this was not allowable. They bought the cinemas cheaper in the first place because they were so dilapidated. So they're trying to argue that the repairs and maintenance costs that they spent on those cinemas were part of the purchase cost of the cinemas and not a running expense of the cinemas. Therefore, the tax treatment again is different, so they weren't allowed that deduction. In the end, they won the case, and they were allowed the deduction for the repairs and maintenance, but that was because the cinemas were still in a usable condition before they started incurring expenditure. So again, it's a complicated area. Again, seek advice if you've got large amounts of money that you're spending on repairing something that you're going to use in a business, like a lot of money being spent on a repair or a machine, for example. So yeah, just be careful of that area. A few random ones. So some legal fees. Generally speaking, legal fees against for debt collecting, say, or whatever it might be, allowable. Legal fees associated with buying property, or anything that's to do with capital transactions, or like legal fees to do with a long lease, for example. So if you're renewing a lease and it's more than 50 years, then that is disallowable, but it's just a bit of an odd one. The business can still pay for it, but you just don't get the tax relief on that. And lastly, entertaining. So customer entertaining and customer gifts. Generally speaking, again, the business can pay for that entertaining, can pay for the gifts, but you wouldn't get the tax relief on those costs. And quite a lot comes under the category of entertaining. It's a bit of a grey area, especially when it comes to business meetings and things like that. So again, perhaps seek advice. Gifts, It's allowable if the gift is under £50 per accounting period, but it cannot be food, cannot be tobacco, things like that. And again, it has to have a company logo or advertisement on it. So say, for example, you gifted away a calendar, and on that calendar it had your company's name or logo or something. That's kind of a form of advertising, so that would be allowable so long as it cost less than £50, basically.